The US is still our largest long exposure, even though we're underweight. It's still our biggest exposure on a regional, North America on a regional basis in the portfolio. What do we own in that market? Well, we're biased towards the global companies in that market. The commodity companies we like in the gas space, GE as a leading industrial that we believe is significantly undervalued as a structural grower in aerospace and healthcare. And companies like Cisco and Microsoft. So we own multinational US companies. We don't own the domestic market because it's significantly, very overvalued on a like-for-like basis. If you compare, US banks to European banks or emerging market banks, you're paying much higher multiples for less growth in the US. And that can be repeated across most of the US domestic sectors. So, we certainly, think that the US domestic doesn't really offer you that margin of safety. In fact, I'd go as far as saying that it's starting to look like an interesting place to be short. Because you think about what tariffs have done, I suspect it's probably triggered a lot of inventory build by US corporates. So the great growth that we've seen as a result of, where the market's extrapolating, potentially something that is unsustainable, i.e. inventory build. So I wouldn't be surprised that early next year we start to get some pretty disappointing numbers out of the US, which would be a trigger, I think, for a reasonable sell-off in some of the domestic cyclicals. And we're certainly building up shorts in some of those areas, especially if we can see a domestic cyclical that's also about to have its business Amazoned. And that's what I think investors are underappreciating, is just how big as disruption grows, the victims grow more numerous, and some of there's this big bias towards quality stocks. Quality is fine as long as you're not, it's not deteriorating. And I think in the retail space, in the transport space, we're starting to see a combination of high multiple company also, having its business eroded by new competition, changes in technology, and investors are not sort of joining the dots. Plus, you could get this potential disappointment in the environment as we unwind some of the inventory build. There's a lot of cost pressure coming through in the domestic US. If you're a company that doesn't have pricing power, your transport costs are going up, your wage costs are going up, and that's eating a lot of the tax benefit. And also, if you think about it from the consumer perspective, a lot of the tax benefit's been eaten by an increase in fuel, in oil prices. So it's not as fabulous as some might suggest.